Hey everyone, it's Ben Hardy here, and in today's going to be talking about what happened to auto credit over the course of March because there were some very large changes. Before we get in this video though, as always, if you want to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. So the data set that I'm going to be going over comes from Cox Automotive, and it's pretty fascinating because last month obviously was a month where we had several bank failures, and so the underlying assumption was that credit was going to get tighter, that it was going to be harder to access credit, and that's not what happened. Credit was actually easier to get in March compared to February by a marginal amount, 0.2%, but it was still easier to get. However, year over year, credit is still tighter by about 5.5%, and compared to February of 2020, which was just before the pandemic, credit's still about 1% tighter. And so credit is tighter compared to what it was during most of the pandemic and frankly prior to the pandemic as well, but credit is still on this trend where it's continuing to loosen, where it's easier to get access to auto credit. However, although it was easier to get access to auto credit, it's not all good news. The average person that took out a loan in March compared to February paid an interest rate of 43 basis points higher. And so again, this just shows that, well, yeah, rates keep going up. And so people are going to have to pay more in interest. And then the other thing that's fascinating is the percentage of subprime buyers in the auto market increased. So the share in February was 11.9%. And last month in March, it was 13.4%. Now, year over year, this is still down by about 1%, which again, it's an amount, but it's not as much as you would think. And so what this is showing is that, again, auto credit was easier to access. There are more people getting auto credit that have bad credit, and we're getting to the point where we're about to have probably a year over year increase with those subprime buyers. Now, the other thing that I see as good news is that the percentage of people that took out a loan that was over 72 months declined by 0.3 percentage points and was down by 0.5 percentage points year over year. So basically, people are taking out shorter and shorter loans, which actually is kind of a good sign for the health, I guess, of auto credit. But not everything is equal, because despite the fact that auto credit loosened across the board, there are certain segments where auto credit actually tightened over the course of March. So credit unions tightened the most with auto credit, and big banks are the ones that tightened the least when it comes to auto credit. And then it was actually harder to get a used car loan than it was to get a new car loan in the month of March. But this is a little bit deceptive because the average person that purchases a used car generally makes less money and has a lower credit score than the average person that purchases a brand new car. And so it actually kind of makes sense as to why auto credit is going to be harder for people to get with used cars, just because of the demographic, right, that is on average purchasing a used car and taking out credit to purchase said used car. But I think that it also kind of just shows some of the market dynamics that are currently happening where, well, new car interest rates are a lot lower than used car interest rates. And lending institutions just always like new cars because they have a warranty attached to them. And so the chances of someone not making a payment because they have to pay for repair costs is significantly lower because, well, stuff can get covered under warranty instead of having to come out of pocket for the consumer. And again, that's the biggest reason why you see lower interest rates with new cars versus used cars. But it'll be interesting to see if this trend continues where credit for new cars just continues to get easier and easier, whereas credit for used cars continues to get more difficult to access. And this leads me into bringing everything together and talking about what this means for the market. So with credit availability improving at the same time that interest rates are increasing, this is actually a pretty good sign, in my opinion, for the overall health of car sales, because what this means is that although the average consumer is now going to have a higher car payment, there are going to be more people that will get approved for cars, which means there will be more cars that are going to sell. Now, you can decide if you think that higher car sales is a good or bad thing, but I think we can all agree that that's positive, right, for the auto industry itself. But something that I see that is really important to focus on is, again, that split between credit availability for new cars versus used cars, because we are currently experiencing a market where new cars are increasing in sales volume, whereas used cars are declining in sales volume, and used car prices are currently declining. And so if you have a market where the prices are declining, right, marginally right now, but they'll probably increase in the future, and the sales are declining at the same time that it's harder to get access to credit to buy these cars, this is like a recipe to really put downward pressure on the used car market, and frankly put upward pressure on the new car market, not necessarily in the form of prices, but in the form of volume, because it looks like it's becoming easier and easier to purchase a new car, and it's becoming basically harder and harder to purchase a used car. And so this is all happening at the same time that I've talked about this in other videos, manufacturing is continuing to ramp up. I mean, even brands that are really constrained, like Toyota and Lexus, for example, are starting to get inventory at their dealerships that is not already sold. And so we're seeing this market where there's more and more new cars available, and dealers are having to discount this inventory because they have more and more inventory and they're not selling it quick enough. And then manufacturers are having to roll out discounts because they're realizing that, I wouldn't say that they're necessarily overbuilding, but they're building enough to basically go above what current demand is. And so again, it's all leading to this market where we're probably going to see a huge, it's already happening, but a much bigger shift towards new cars. More and more people are going to become new car buyers. And again, it makes more sense to purchase a new car right now with the current pricing of used cars and the interest rate differences. Again, the average interest rate on a new car is like 6-something%, whereas the average interest rate on a used car is over 10%. And so with some used cars being as expensive as new cars, it's like you might as well get the new one where you're going to get a lower interest rate. It's a brand new car, so you don't have to worry about anything that's happened to it. And if you're getting discounts to where it's similar in price to the used one, it's like, why the heck not? Let me know what you think about this whole situation, and I want you guys to let me know what you think about a few key things. So first off, do you think that lending institutions should be loosening, with their credit, right, availability? Should they actually be giving out more loans, or should they be giving out fewer loans? And on top of that, do you think that it's good that there are more subprime buyers in the market? Do you think that that's a sign that the market is moving in the right direction, where things are getting healthier? Or do you think that that's going to cause things to get even worse because you're going to have more repossessions in the near future because you have more of these subprime buyers that are probably not going to actually make the payments on these cars that they're taking loans out on? Be interested to hear that. I'll see you.